and good afternoon, everyone. I'm really delighted to join you for what I think is an incredibly timely discussion on building resilience in Africa. I would actually start by acknowledging the recent earthquake that struck Morocco. I think that is a really sobering reminder of the unpredictable nature of crisis and why it is so urgent to build resilience. Today's topic is of immense significance to sustainable development, not just in Africa, but everywhere. We live in a world that is marked by economic turbulence, by environmental challenges, by political uncertainty. So, the ability to withstand, recover from crisis is really paramount. And so we're really grateful to our partners at the IDRC and Global Affairs Canada that made this event possible, but more than the event, they've actually supported the research that goes beyond the event and is research on the impact of global shocks on vulnerable economies, particularly in Africa. We've been doing work on resilience for a long time at ODI, and all of our work really highlights the importance of holistic, inclusive policies that can help countries weather storms and can help safeguard development outcomes and development gains. And so today, I think we have an important conversations because we bring in together the research and the perspectives of global majority countries with global institutions like the World Bank and the IMF, and that is through deep collaboration with fantastic organizations like the Africa Economic Research Consortium, the Economic Research Forum, and the Partnership for Economic Policy. And I think this convergence of expertise and perspectives is, what we need to really generate inclusive, comprehensive discussions on resilience building. It's what can allow us to bridge the gap between rooted experience and high-level policymaking that can create policy responses and interventions that are more contextually relevant and more effective. And so I think I'm really looking forward to the discussion. I think we have an opportunity to try and shape an agenda that can help countries navigate mounting uncertainties. I think we have an opportunity to build more just, sustainable, resilient economies if we share insights, strengthen evidence, and inspire action. So once again, I'd like to really express my sincere appreciation to IDRC, Global Affairs Canada, my colleagues at ODI, and our partner organizations that really put a lot of time into generating these conversations. And so I'm really looking forward to thought-provoking discussions on how we can weather the storm and ensure that we build greater resilience in the face of global shocks. Thank you very much, and back to you, Dirk.
Thank you very much, Sarah. So let me now set out the panel and who we've got here. So we're going to discuss resilience building and the prospects of African countries in the face of shocks. First, on the basis of two presentations by two multilateral institutions. So first, we will have a presentation, opening remarks by Kathy Patillo, who is the Deputy Director of the Africa Department at IMF, and we'll know about the importance of the regional economic outlook, for example, on Africa, and a range of other publications that you've recently undertaken. And we're following up on the previous conversation that we've had when you visited ODI a couple of months ago. We will also have a presentation by Andrew Debale, who's the Africa Region Chief Economist at the World Bank, and they've also been engaged, of course, in a number of publications, regular publications, but also monitoring publications like Africa Pulse and others, also setting out how Africa is faring in the current context of shocks, and also highlighting particular policy implications. What we will then do is move the discussion to discuss the research findings of research that has been commissioned by the IDRC from organizations like the ARC, that's the Economic Research Consortium, and the ERF. And we have two representatives here, so Dr. Diana Ngumchai from the ARC, and also Dr. Ibrahim Al-Badawi from the ERF. And then we're hoping to have two further perspectives on the prices, and particularly we're looking at the research on commissioned by the IDRC in the Russia-Ukraine war and how that's affecting African economies. We're looking at two perspectives. One is on the gender perspective, so how are African women faring during the crisis, and we're also hoping to look at monetary policy responses. Phyllis Papadakis will be discussing the gender dimension, and Professor Victor Moringa will be highlighting the monetary policy responses. And so we've got a mixed audience both here in Marrakesh, and we've got a significant number of online participation. So we encourage you to use the chat for any comments that you like to make, and I'll try and pick them up as the moderator of the event. So I think we should first have some framing discussions, framing comments by both IMF and the World Bank. So first on, we've got Kathy Patillo, who is the Deputy Director of the Africa Department. And so we're very interested to hear your latest thinking on African economies, how they're weathering the storm, and also perhaps to provide some pointers as to how the IMF is supporting African countries through the crisis, whether it's the COVID crisis, the Russia-Ukraine war, and now of course the inflationary pressures that are still persisting. So maybe over to you. You can take them from there, or you can come here.
ماشي تصورش تحت فوق بس الآخر يعني.
Okay, sorry, just getting settled here. So good afternoon, and it's really a pleasure to be here. I enjoyed so much the visit that we had in London, engaging with ODI and the research network that which is really vital to having more of an evidence base, I think, for understanding the impact and how we're going to move forward on these discussions, which are, longstanding, but where now we have a lot more developments and I think evidence that will help us to find our thinking. So I wanted to start with some update from the IMF on how we're seeing the outlook, and then maybe talk a little bit about some sort of priorities on the resilience building, and of course I'll mention how the IMF is supporting countries. So we are seeing that, of course, in 2023, the region has had a very difficult year, but our message is a little bit more hopeful now, because we're stressing that with strong economic policy, there could be light on the horizon. So in 2023, again, growth is going to decline in the region, the second year in a row. We've got still very slow international demand, really expensive, difficult to access financing, what we were terming a funding squeeze. Exchange rate pressure is still hampering the recovery. we've also seen, of course, the increased number of coups reflecting the really persistent fragility in the region. So the second message is, though, that despite these challenges, many countries actually did work to the best of their ability well to weather the storm, and 2024 looks somewhat brighter because of this. So we're set to see, a growth rebound in the region and it's not just, a couple of the major economies, but 80% of the countries then will see an increase in growth. They are set to see an increase in growth in 2024. And the non-resource economies, the more diversified economies, are going to continue to perform strongly. So growth in these diversified economies is getting to levels, relatively decent. It's still not enough. Per capita growth is slow. It's not making up for the scarring. It's not making up for the, continued divergence, but in the right direction. On some of the other indicators also, we're seeing inflation falling, public finances, stabilizing, and we're seeing much needed subsidy reforms in place in select countries, of course, Nigeria, but also Angola, Zambia, the Gambia. In Nigeria, the fuel subsidies had previously cost 4 times as much as they were spending on the health budget. So this, as well as the exchange rate reform, were the critical reforms in Nigeria, really bold reforms of the new government. So, we're seeing these steps in the right direction, and debt. Again, debt is high, and there are incredible debt vulnerabilities. But this year, we're actually going to see debt levels stabilize for the first time. They've been on an increasing trend in the past 10 years. So again, some improvements. Our third message, though, is really that it's way too early to celebrate. In many cases, inflation is still too high. Government's borrowing costs are elevated. Exchange rate pressures are persisting, and this political instability is ongoing concern. And again, growth, even though it's picking up, is nowhere near what's needed to improve living standards, reduce poverty, start to address the big setback we had during these multiple years of crises. And so we highlight, a number of the policy priorities on inflation, on exchange rate vulnerability, on addressing debt vulnerabilities while having space for development spending, and on improving living standards. So just to mention for the fund, the IMF has been supporting to our utmost countries during these difficult periods with our capacity development, with our policy advice, but really stepped up financial support at a time where there was such difficulties and need for countercyclical support, given the lack of availability of other financing, low reserves in lots of countries. So, in the past 3 years, IMF provided $55 billion to the region with the SDR allocation and lending, more than most other years. And we have these new facilities also that to deal with the food shock, the food insecurity issues, food stock window. 4 of the countries that have received food shock windows are in sub-Saharan Africa, around 358 million. The Resilience and Sustainability Trust, again, we've had 11 RSF programs 6 of which are in Africa. The latest one, Morocco, the other 5 sub-Saharan Africa. So helping countries to build resilience to climate. The money is small drop in the bucket given the climate needs. And so one objective of the RSF also is to help countries catalyze more private climate finance, private and other finance. And I think there has been progress on this at the Paris Summit. Rwanda was able to make some announcements on additional financing that they've been able to mobilize for climate action in their strong policies and framework. And we're playing this role of working with partners to discuss all the things that all the partners can bring to these countries. So maybe just finally on resilience building, we'll get more into it, I think in depth, but I mean, it is a time where, given the shocks, and we're going to be in a more shock-prone world, we're going to continue, as Sarah was saying, with fragmentation and to have this uncertainty about how to navigate trading relations and in relations more generally. We're going to have, the impact of the China slowdown and higher impacts on oil prices or food prices. So we're going to continue to face all of these shocks, and Africa cannot change what happens in China. It can't change what happens to climate. It can't change what happens, to commodity prices. So what it can do are all these steps on resilience building. And there's a premium, I think, on the basics, of macro stability. The how to do it is much more difficult now with the shocks and with high inflation, high debt, big development spending needs going forward, but also for the catch up. So how to navigate these and have the basis of continued macro stability is much more challenging. And then there's the most important inclusive growth agenda. And on the inclusion side, as I was mentioning, countries are looking at how to manage debt vulnerabilities, but protect social spending, look for ways to step up social protection, social assistance, to make that more shock calibrated by having social registries and identifying people and linking databases and knowing who is hit by shocks. So that's on the fiscal, and then there's so much potential really for more private sector activity and utilizing opportunities like the Afro-Continental Free Trade arrangement to boost competitiveness and growth and rely more on those internal opportunities given the challenges of the external environment. And we can talk more about all of those. Thank you.
Thank you very much. That's very helpful. You mentioned there's light on the horizon, sort of the main message there. You also mentioned that it's far too soon to celebrate. Maybe just one quick follow-up message on that. I think you said, well, we can't do much about all the commodity price shocks, the shocks that are happening. As such, the shocks will happen. The countries are exposed to shocks because they deal with international economy, rightly so. But what we can do is to sort of think about policies to build resilience against those. And one thing you mentioned in your presentation was that diversified economies will grow faster. So you also mentioned that IMF has stepped up. Maybe some would say maybe not enough, but it could do more. But you've stepped up. But I suppose the question then also becomes: have you helped? Can you help countries also to become more resilient and to become more diversified, to transform their economies? And are there any ways in which you can provide that targeted support? It's just one quick follow-up question.
Yes, so yeah, and I think that is a key advertisement then for the value of diversification in helping build resilience. That those economies have been doing better and are projected to do better. So that, you know, if you look at the potential for doubling living standards in these diversified economies, you know, it's within a lifetime horizon, whereas for the oil exporters or resource intensive, given the incredibly slow growth, the amount of time that it will take to double living standards is just unthinkable. So, I mean, diversification is a really, you know, multifaceted, difficult process. There are countries that we look at, for examples. The debate right now, I think lots of places, is on industrial policy and whether, since there's a lot of discussion in advanced economies on the role of industrial policy, whether this is something that we should be, you know, providing more support and, you know, policy advice to countries on. So it's something we're thinking about internally. But you know, the first step, I think, still is more across the board, horizontal type reforms that are all the standard reforms, but where countries, you know, who have struggled to eliminate those kinds of constraints, like lack of energy access, then, which is not going to allow new kinds of businesses to develop, are still struggling. Access to finance. So an overall agenda, I think, that we have thinking about countries and diversification, is build those domestic resources so that you will have some more space for investing in the things that do cost money. And then there are things that you can do that don't cost money. And so we're working with countries in both of those areas and thinking about some of these new questions.
Thank you, very helpful. I'm sure we'll get back to the horizontal and vertical policies in a minute. Let me now turn to Andrew Badan, who's online, and so you're the chief economist of the Africa region and in charge of a range of publications around economic performance of African countries, and including Africa Pulse. So I would be quite interested to hear your views, the sort of similar type of questions that I asked Kathy Patillo as well. So Andrew, over to you. Maybe you can make your introductory remarks.
Thank you very much, and it's a pleasure to be with you. Hi, Kathy. Hi, Ibrahim. It's good to see you. Can you hear me? Okay, very good. So look, so Kathy has already provided a really good overview of what we see in the region. So let me be very brief so that we can get to the details of the discussion. So we too see that, in fact, the continent, and just for the record, I cover only sub-Saharan Africa, so I think it's really important to keep that in mind. You know, the World Bank has a different kind of arrangement about how it administers Africa. So I think whatever I'm saying here is really in reference to what we see in sub-Saharan Africa. Now, having said that, so we see a slowdown for sure, and a substantial slowdown actually. We think economic growth has actually declined from about 3.6% in 2022 to about 2.5% this year. So that's a substantial deceleration. And we attribute it to 4 reasons, right? One is a really big slump of the big countries in Africa. So about 6 countries in Africa make up 65% of the GDP of the region. That's Nigeria. That's growing at about 2.9% this year. South Africa, which we expect to be growing around 0.5%. And then, you know, Ethiopia, which has these issues, as everyone knows, then Kenya, then there is Angola and Sudan, which we all know is going through a really difficult time. So all these countries are growing very slowly. So that's one reason. And there are many reasons why these countries are growing slowly, but I don't want to go into depth in each one of them. We can come back to that, but that's one reason, that they're dragging down the growth of the region. The second, of course, is the rising instability, especially as you see in the Sahel, in the Horn, and so on. And the third is just the number of shocks, and that's a subject, of course, of the number of shocks that have hit the region in recent years that have created a real drag on recovery, and as a response to that shock, of course, we see these elevated levels of debt, which are making it difficult for these countries to mobilize resources in order to invest in core development issues like health, education, infrastructure, and so on. Right, so they literally don't have any space now for borrowing in order to finance the core development issues. And then finally, of course, the global economy is in a slump in itself, and it's not coming to the rescue because typically what happens is that these countries very reliant on trade actually for their exports and income. And whenever the global economy is in a downturn, there are huge hit to their revenues. So those are the four reasons. Now, but even though, in fact, the second point I think that's important to remember is that even though 2.5 seems, first of all, it's low, but it is positive. Except that if you actually account for population growth, which also is growing at 2.5%, GDP per capita is practically zero. But it's been zero for almost 10 years now. So that's the key. And it's been, so the subcontinent has basically completely lost a decade. And that loss began in 2014 when we had a real downturn in commodity prices. Right. So it just tells you how much this continent depends on these commodities for its economic survival, right? And so that is the real concern that, in fact, this whole issues around African development raises, because if you really think about it, the growth prospects and the three features of African growth is that, first, in per capita terms, not just this past decade, but historically has been low. It's never really grown beyond 2% per capita at any one decade, right? That's one. Second, it's never sustained over long periods of time. In a way, you would see, if you look at the history of this continent, you'll see these, 10-year periods, 10, 15-year periods in which they're growing at maybe 2% per capita, and then there is a downturn of another 10, 15 years where they're growing at 0, and then they recover to 2, and then they're down to 0, and so on and so on. So it's never really sustained, and because of that, it's impossible to reduce poverty or even create jobs, right? So that has been the key feature. And then, of course, the third reason, the third feature of African growth has been that it is too reliant on a narrow set of commodities and trading partners, right? So that's the conundrum they face. So one of the things that we argue in the report is that the region really needs a new growth model. Where really seriously think about raising this trend, per capita trend, where you sustained this per capita trend, the new per capita trend for decades and not every 10 or so years, and where in fact you diversify the economy, the economic base, right? So that's and we have work in the process trying to figure out how to do that, but I don't want to get into details of that because this is an opening statement, but that's sort of where we are now. The way the World Bank is trying to help these countries, of course, are threefold. One, to build resilience. One is, of course, as Kati said, the most important thing right now is to really maintain some stability, particularly macroeconomic stability, right? So, and that means, making sure that, inflation comes down, stays low, is maintained for a long time. Debt levels are either stabilized or they come down. They put in place, institutions of budget and debt management that are credible and stable. So those are some of the things that we're working with them on. We are, of course, working with them on building another, one of the, there are two, so far there have been two engines of growth for the region, right? One is the external engine of growth, where they trade outside, and then internal. I think the one thing that I think is missing is the intra-African engine of growth, right? So one of the things that we're trying to help these countries with is, of course, help them with, integrate more at the sub-regional level, but eventually, of course, continentally. And so we have a lot of projects on trade, particularly on opening up corridors, trade corridors, such as in the Horn of Africa, Abidjan, Lagos, the East African region, and so on and so on, right? So that's one thing we're working with them. There is a big program on food security. Fundamentally, one of the big problems about the lack of resilience in the region is just the lack of structural structural transformation of especially the agricultural sector, but overall the economy. So and at the bottom of that is, of course, the water management issues, especially for agriculture and the adoption of technology. So that's something we work. So we have a program on food systems and resilience program, food security and resilience program. And then finally, of course, working with these countries to make sure that they protect social spending, and we have worked with them on social protection issues and so on and so on. So in a nutshell, that is, and there's a lot to talk about here, but in a nutshell, that's the story that I thought I would open up with. Let me stop here. Thank you.
Thank you very much, Andrew. That's also very, very helpful. 10 years of 0% growth, GDP per capita not growing. We need to focus on stability, but there needs to be a new growth model, which is really important. And I think you also highlighted the African integration importance of African integration. I think that's also something that I read in the IMF special issue on Africa. And so that's quite interesting. I don't know whether you can say a bit more on that, but you're basically saying that the African integration is going to be helpful in finding this new growth model.
Yes, precisely. So I think so. For example, let me just give you an example of what happened in 2008 when there was a financial crisis. And what happened is that some of these countries that Kati mentioned, which are diversified, we also see actually that resilience really has a lot to do with the diversified economies, right? In West Africa, it's usually these countries like Cote d'Ivoire that have maintained some level of resilience in terms of their, protecting their growth levels. It's Cote d'Ivoire, Benin, Togo, Senegal, that are not too dependent on extractives. And then in the rest of the continents, Eastern African, that around the lake, Kenya, Tanzania, Uganda, Rwanda, and so on. Now, I mentioned 2008 because one thing we noticed is that when the financial crisis hit, a country like Kenya was able to actually maintain some level of resilience because it was able to divert its trading with its neighbors. And so that is important because I think deeper integration of these countries, what that means is, first, the markets are larger. The farms, maybe more established farms will enter because right now what we see is very small enterprises in Africa that dominate the scene. But if you have a much larger, stable market, you probably will attract much more established enterprises, and that will create jobs and reduce poverty for sure. All right. You will probably have better competition and better product quality and selection, and you will raise the productivity in this economy. So there's a lot to like about the idea of actually integrating more and creating bigger markets that are open.
Thank you very much. I think that will resonate really well with also the findings from the research. And I would like to turn now to those findings. So on base of two presentations. So first, Diana, maybe you would like to sort of discuss the modeling studies that you've been involved in, and also sort of think through the policy implications of that for resilience building. Over to you.
All right, thank you very much, and I'm very glad to be in this forum. We've been involved in a project, namely impact of Russia-Ukraine war in the low-income countries and the middle-income countries. Basically, what we have done in this project is to see what is going to happen if these shocks are there. So basically, we are not ignorant of the fact that there are other factors that have been around, like the COVID-19, and we also have the climate change. So we have had to do, to my colleague Ibrahim will present for the country case studies. For this one was at the macro level. We did the global computable general equilibrium. Our colleagues PEP, thanks to them that they did this particular research. And at the African Economic Research Consortium, we did the global vector autoregression model. And sort of all these studies, we have done simulations and to see what would be the impact. For instance, for the global vector autoregression model, we tried to see what would be the impact if we have the shock on the oil prices, on the food prices, and on the fertilizer prices, coming from the fact that these are the major things that happened during when the war started. So basically, we limited ourselves to that. But again, we are cautioning that we are not ignorant of the fact that the other factors still persist. So basically, what we find with this, we find that for the commodity terms of trade, there's a significant deterioration. We're also looking at real GDP. There's also a decrease there. We're also having inflationary pressures because of these shocks. And we also have a decrease in the purchasing power in many African countries, of course, looking at the oil, food, and fertilizer price shocks. When we get to our colleagues in PEP, basically, they are looking at the trade distortions over time. And what we see come out clearly is that at one part of this, we find that this reduction, basically what would say a drop in the economic growth, basically what we've just heard from our colleagues. But again, we find that this is much significant in the Sudan, Kenya, and Ethiopia. They are having a drop in the economic growth with more than 1%. And then when we go down and look at the consumption, we also noted that much of the African countries, their share of spending is much higher. Of course, average, we have like 41%. So we find that some countries are having up to 60% when you look at like South Sudan. So when we get to the reduction, we find that there's a reduction in agri-food consumption, and it is stretching from about 6% in real terms relative to the baseline. And this one, we are looking at the North Africa, all the way to about 2.9%, of course, which is observed in East Africa. And this one resonates with how much these people are spending in the food. And what about when you bring the shocks? You find that this kind of reduction is going to be so unimaginable. So when we get to the specifics, we find that the spike in the global inflation, and this one reduces the purchasing power of the population. It also decreases the total consumption. For example, when we look at Ethiopia, Sudan, again, and Kenya, we find that for like Ethiopia and Sudan, there's quite much significant, reduction in the consumption of all products. And this one is in the short run. And this one goes even up to 2030. The same case when to look at the reduction in the agri-food. Now, moving fast forward, when we look at all these impacts, what do we recommend? What do we say that these countries should be key to looking into? Basically, we are seeing that in the short run and the long run, this kind of impacts are going to persist. They are not ending very fast. So we've talked about diversification. One of the key things we are talking about here is, for example, if you're looking at the sources of supply of the food, the countries should diversify the sources of supply. Basically, they also include domestic production, and also they release the existing stocks and diversify also the import sources. And just to note that quite a number of the countries are net importers, and that's where you find that they are quite affected. For the oil exporters that are getting more revenue, we sort of recommend that they utilize the windfall to support the economic recovery in the short run, of course, and replenish their policy buffers, and well, to reduce dependency on import energy, on the imported energy, which most of the countries are doing. So we also recommend that they also diversify their energy sources. They can move towards renewable energy policies. And of course, what my colleagues have talked about, they take advantage of the FCFTA, basically the interregional trade. And just to finalize, we have talked about them doing investment and looking at productive investment, because basically they cannot just, we cannot just recommend policies like diversification of the energy sources. These are key priorities: getting to self-sufficiency agriculture. They need to invest in technology, research and design, and so on and so forth. So basically, where do they get the funds from? Apart from looking, at the World Bank, at IMF, we're also telling them to leverage the financing opportunities and break new grounds. And one of them is the African Continental Free Trade Area, which I've talked about. For this one, they can facilitate the cross-border payments in local currencies, if that is done. And they can also reduce transaction costs associated with the multiple exchange rates. We found that the exchange rates, basically, they're affected because of the war. And they also leverage on investment platforms to foster dialogue between government and investors. We're also saying that they should scale up domestic resource mobilization. I know this is quite a bit hard, but you're telling them to strengthen their public institutions and sort of do capacity building in these institutions, so that at the end of the day, they'll be in a position to get more funding. They can reduce the illicit financial flows, and also try to review tax exemptions among many things. And of course, we are also saying, while they're leveraging the financing opportunities to invest in this productive investment, they should increase access to financing at affordable rates. And of course, for this case, we are looking at supporting the capitalization of MDBs. And of course, you also look at, like leveraging on the Afrexim banks, the VAT procurement model for items of first priority, and so on and so forth. So basically, these are sort of the recommendations we are making. So going forward, we would expect that with these recommendations, as one of our colleagues said, we should simulate them and see how do they look like at the end of the day. Is it something that is going to work? So that is also an area that we look forward to do. Thank you.
Thank you. Maybe I can just quickly follow up on that. It's basically you first identified all the different impacts on different countries from the same shock, which is quite important. You then had a couple of policy implications. Trade was one of them, and then you also said that the international community should break new ground to support African countries. And you started with the African Continental Free Trade Area, and you mentioned payment systems, for example, regional payment systems that are being developed. I'm wondering, also just going back to you and asking the question that I asked Andrew as well, Kathy. You in your Africa publication, you basically say that if implemented well, Continental Free Trade Area can lead to 10% growth, right? Or at least a 10% increase in GDP per capita. What are you doing in the IMF to support African integration? Could you just briefly comment on that?
So the ball is really in the country's court now to implement what they've signed up to, right? So they've agreed already on, I think, 90% of goods then that they would be reducing tariffs on, and then steps on the non-tariff barriers. So in our dialogue, then we are always, talking with countries about how they are working toward their commitments. The behind the border reforms are the much more complicated ones, because those are the infrastructure, the things Andrew was talking about, the corridors, etc. And that is part of our more general agenda on policies that are going to help countries strengthen growth and look, as we've all been saying, given the declining demand potentially with slowdown or China slowdown, looking for those opportunities internally. On cross-border payments, also that would be something that from our Monetary and Capital Markets Department, there is I'm sure discussion on if there are requests for technical assistance on setting up that kind of cross-border system. We're doing quite a lot of work on cross central bank digital currencies, and the links then between different types of CBDCs and mobile money. And on the CBDC side, another one of these questions is the value of interoperability, then being able to have greater ability for interoperability within a country, and then cross-border, the potential for better cross-border payments. So the agenda, I think, is broad, but we see the first step, is that countries to do what they've committed to do and step forward.
Thank you very much. Thanks, Diana. Shall we now turn to Ibrahim Al-Baghdadi, who's managed the country case studies, or the ERF has managed the country case studies. And Ibrahim is also a former finance minister, so maybe you can also comment from the range of perspectives on how to sort of build resilience more generally, and particularly in the light of huge food price increases, partly induced, of course, by the Russia-Ukraine war. So over to you to discuss the country case studies.
Thank you. Yes, actually, I think building upon the previous presentations by Kathy, Andrew, and Diana, here we try to actually, zoom in to some specific case studies, which was designed to be complementary to the global analysis within the macroeconomic, using the macroeconomic models. So we picked 6 countries, and we thought these are countries that have the potential of relocalization and building deeper development corridors, trade corridors, and so on. And these countries span the continental Africa. So we have Sudan and Egypt, and we have Morocco and Senegal, and we have Kenya and Ethiopia, and then Mozambique, South Africa. We first characterize the extent of the shock. The shock itself is much more challenging than the traditional commodity shocks, because it affects the entire, span of the supply chain. The COVID, and then of course later on the war, Ukraine, they all affect a range of intermediate manufactured products that actually, generate inflationary spirals in countries, especially those countries, almost all of these countries with varying degree of course, are heavily dependent, especially on food and some key inputs. Like for example, one intriguing thing is that Kenya is highly dependent on Ukraine, input for road building, asphalt. But then all of them, of course, they depend on imports of grain from Russia and Ukraine. And so that affects one key aspect of food availability, which is, of course, primarily is impaired by the low productivity of agriculture in most of African countries outside South Africa, but by international standard, productivity of agriculture is not as high and modernized. The other aspects of food security obviously includes accessibility, which was essentially also negatively impacted by the shocks, because actually it triggers inflationary response that make it very difficult for poor and those households that are closer to the poverty line to have access, and created a major crisis in a few countries. So the question then is, what has been the response? The response by many countries has been to try to provide cash transfers, such as what we did in Sudan, but also in Morocco and Egypt. In other countries, is to subsidize commodities, food commodities. But by and large, central banks have been reactive. They have not been anticipatory. They didn't have the capacity to anticipate shocks like this, potential consequences. And many central banks also were constrained by the nature of the exchange regime that they've been adopting. And this actually, is one area which is really macroeconomic reforms or macroeconomic institutions that are much more adept or agile to respond to shocks. I think that would be an important, research in the future. And I have some ideas here that I don't know if you want me to share it now or later. But then let us speak about the potential of relocalization. Right now, if you look at just the pure trade flows and so on, these countries do not trade much, and the potential is probably limited. But the Maputo corridor showed us very clearly that with more broad-based regional cooperation, harmonization of policy, building of public goods, regional public goods, can actually be quite effective. South Africa has helped, I think, Mozambique, according to the analysis that the case study of South Africa, Mozambique, to weather at least, an unnegligible part of the shock in terms of availability and accessibility. And we found that actually, the kind of the baseline conclusion is that, the potential is more than meet the eye, in the sense that these countries do have the potential, because of their geographic contiguity, to actually develop much more robust relocalization and development corridor agenda. Take the case of Egypt, Sudan, and Ethiopia. There is a huge potential. The same also Ethiopia, and the rest of East Africa, centered on Kenya, of course. And then, of course, Southern Africa, the orbit around South Africa, SADC. And then, of course, you have here in this country, Casablanca is the financial capital of the Francophone Africa. There is huge potential, actually, also to build this kind of regional entities or regional cooperation that could help countries weather or at least limit the extent of the shocks. So I think country studies would be very important in the future, to do more country studies, neighboring countries. I understand that we might be able to do much more micro analysis on distribution of consequences of these shocks, and maybe in the future. Right now, we have one case study that's being under research covering Kenya and Egypt, because of the availability of micro household and labor market surveys. But this would be a potential. The other potential, which I could speak to, is related to the macroeconomic institutions, both in terms of fiscal policy and monetary policy. So maybe I should stop there.
Thank you very much. I think so the methodology was really interesting to look at these country pairs, and you said there was real importance there to collaborate across countries, and so really important to think about a policy response there. And I think that also tallies well with what Diana was saying, and what IMF and World Bank were saying, and also putting in their publication. So I think that's really something to highlight. You also mentioned that countries were a bit constrained in their policy responses, so exchange rate regimes and some others. Maybe you could say a bit more on that. So what helped policy responses? So what is the sort of the governance or economic space dimension of resilience, perhaps? What caused countries to respond well and not respond well?
Yes, I think, for example, if we think of the monetary policy, for example, in response to shocks, we have the West African monetary unions, the Central African and the West African monetary unions. These are currencies that chose to import macro stability or financial monetary stability by basically institutionally fixing the exchange rate previously to the French franc, and now, and of course, after the European monetary integration into the euro. These have helped these countries, quite well for some time. But I think now, not now, even much earlier, there was a realization that these have also constrained the responses of these countries to shocks and also the long-term competitiveness of the economies of these countries. And right now, there are lots of discussion about transiting to more flex exchange rate regimes, but they are also institutionalized, such as, for example, inflation targeting connected with fiscal rules. In a context of transition from discretionary fiscal and monetary policy, or at least fiscal policy, to rule-based, fiscal and monetary policy. The experience of some experiences around, obviously there are issues of capacity, level of sophistication, and what have you. But a country like Chile would be an interesting country to look at, in terms of this is a country that actually, introduced fiscal rules together with inflation targeting, and organized a relationship between the Ministry of Finance and the central bank, which is absolutely interesting in terms of harmonizing the two aspects, the two pillars of macroeconomic policy. And copper accounts for 1/3 of the economy of Chile. But the capacity of that country to respond to the shocks in the copper market, global copper market or international copper market, has been quite remarkable. So I think there are possibilities to look into this from a macroeconomic perspective, assuming that we are probably moving into a new normal of global shocks and global supply, global supply disruptions and its consequences. This is on the macro. On the social protection, I think there are issues related to, obviously, which Andrew talked about briefly, related to the role of governance, role of the state. What should the state do in terms of services? For example, the Middle East Department of the World Bank produced a very interesting report identifying 3 roles for the state. That the state should be, a service state, that, the public sector should a delivery state, or a provider, service provider that provide opportunities for the citizens, including low-level government, civil society, to have a space. And then as a regulator, also to provide a space to the private sector. Many countries actually, economic reform, such as exchange rate adjustment, might have happened. But because it did not really were not done in a credible way that changed expectation, anchor expectation, so that the private sector commit investment and so on to the reform. And so the private sector has to be given a space in order. And then the last, the last idea related to the role of the state here, in a particular, in a very economistic way, is the evaluative state. But actually, it is a learning process for the state to evaluate the projects and to assess and so on going forward. So I think there are opportunities to go beyond analyzing just the immediate consequences of the shocks in terms of anticipating how to increase and to enhance resilience going forward. Thank you.
Thank you. That's also very interesting. So to think about the institutional context within which policy responses are made, and you highlighted, for example, the fiscal rules and inflation targeting, and the collaboration amongst actors, sort of fiscal and the monetary space, in order to respond to shocks. That's really important. Earlier in your remarks, you mentioned also that it's very important to look at the distributional consequences of shocks, and particularly the distributional aspects of the Russia-Ukraine war, the impacts of that, the distributional impact of that shock in African countries. So my colleague Phyllis Papa-David has just released a paper on how women in Africa are faring in the context of macroeconomic shocks such as the Russia-Ukraine war, which is also based on the work that you're undertaking, and I know there's a lot of ongoing work going on, and particularly in the future, the phase 2 of the research, you're going to look much more in that. But perhaps I'd like to turn to Phyllis Papa-David to present some of sort of the key pathways through which women could be affected through macroeconomic shocks such as the Russia-Ukraine war. And perhaps that may also then lead us to think onto sort of a new research agenda on distribution of consequences that you're, I think, interested in. And I will come back to you as well about new research avenues in a minute, and Diana as well. Thank you. Phyllis.
Thanks very much, Dirk. So we are in a unfortunate situation where global growth is likely to slow to a sub 3% rate, according to the IMF's estimates and a number of estimates. And the thing is that the nature of the price shocks that we are seeing are not gender neutral. Inflation is still in high double digits. It's come off its peak in a number of countries, in a number of African countries, but it's still accelerating in a number of other African economies. And as has been mentioned, depreciations and devaluations are pervasive and persistent, which has also inflated food price inflation, which continues to be problematic. So we know that lower affordability and lower intra-household resources hurt low-income women. And in the spectrum of functions, whether it be as a consumer or producer or caregiver, there is a shock absorber effect going on. And so in the work that we did, we tried to just look at, to progress the discussion around pathways of impact. And also, importantly, look at economic equalizers for women's resilience in particular. So I think this is particularly important as financial instability is likely to continue in 2024 or even deteriorate with a repricing in one asset market or another, or continued dollar appreciation. Is going to be particularly problematic if that actually occurs. And we're also seeing elements of it right now. So it was mentioned before, actually, and I had planned to refer to this as one aspect of the discussion because I think it's so important, is that the IMF's own analysis suggests that a doubling of GDP per capita in a number of African economies, both resource exporters and non-resource economies, is going to take several decades, depending on the country. And what's important about the work on gender impacts is that one essential catalyst for this in the literature more generally and in relation to women is to expedite this kind of productivity is access to finance and access to education. That's the key spillover, really. And more specifically, what we looked at in the work, in the paper, was the scaling and the financing of an enabling environment. So 84% of blended finance vehicles claim to integrate gender into their strategy, gender equality into their strategy. And yet, out of actual assets under management, only 1% is devoted to gender equity as a main objective. And of that, only around 13% is devoted to education, women's education. So an aspect of what comes out of the paper is that financing and scaling financing to equalize for gender equity is particularly significant. So what our paper suggests really is the need for further analysis and discussion to address the growing mismatch between the magnitude of the shocks and the funding resources that are needed to boost resilience in practical terms. Especially when you, as I said, especially when you look at the assets under management of institutional finance, blended finance, and the vehicles that support that. So we looked at those main pathways in the work. I'll pause there, Dirk.
Okay, thanks, Phyllis. Just one quick follow-up question. I mean, there's a lot in there. So it's about depreciations. So that's an important aspect of the job as well. That we've seen a depreciation of African currencies, as well as a massive price increase. And you say that both have had a sort of a negative impact on the position of women in Africa, in African countries. One thing you also highlight is the importance of gender norms in your paper, and perhaps you can say a little bit more on that. So how gender norms are sort of mediating the responses of in countries to shocks, a bit like the institutional point that Ibrahim mentioned about sort of the fiscal and monetary issues. There's also other maybe more micro issues that are conditioning the responses. Maybe you could say a little bit more on that.
So yes, one of the angles that we analyzed, and one of the pathways that we analyzed, is that fiscal spending and fiscal space, or shrinking fiscal space, is one of the mediators, the mediating factors, where in times of crisis or in times of a shock, resources are typically decline, that are usually devoted towards safeguarding women's resilience. Young girls are pulled out of school in certain case studies that we looked at. So it's precisely the policies and the prioritization of women's resilience in times of a shock, right after the shock, targeted fiscal transfers that make the difference and actually see a speedier economic recovery in the aftermath of a shock or crisis.
Okay, thank you. So I'm not sure whether Victor is already online, probably not yet. So he might come online in a minute. So we can now turn to a bit of a discussion, and also we can bring in the audience here, but also the audience online. And I'm already seeing some questions appearing. And so we'll turn to the panel with one of the questions that has come in from Peter Corti. I think he's from ISER, director of ISER in Ghana. He basically suggests that product and export diversification are two critical elements to promote resilience. And I think that has come out as well. So the diversification in products, but also in terms of locations. So destination of your both imports and exports. What are your specific recommendations to make this happen? So I'll turn first to Andrew from the World Bank, and I think also in your publication you mentioned the importance, for example, of the gap in labor-intensive export manufacturing export in Africa as one key issue that is a problem in African countries. And so then it's important maybe perhaps to diversify into labor-intensive manufacturing. But what are the measures to do that? And how are you a bit more advanced or forward-thinking than perhaps the IMF was? Because I mean, Kathy was basically saying that they had considered or are considering industrial policy, for example. And my question is a bit sort of how you are looking at sort of industrial policy to promote export diversification, because if that is so important for both for transformation but also for resilience, then perhaps we should be really thinking about how to achieve that, and what are the best ways to achieve that. What do you think from the World Bank's perspective is the most important ways to do that? And I'll also turn to Diana and Ibrahim to that as well. Over to you, Andrew.
Thank you. So quickly, a few things. I think there is already, examples of successes of product diversification in African economies that have that can be models. So if you take a look at, and so far, of course, these have been primarily diversification around agricultural products. So if you look at, the experiences of Ghana or even Senegal recently, they have actually diversified away from some of the traditional products that they used to depend on, such as, groundnuts or cocoa in the case of Ghana, to horticulture. They've now become significant horticultural exporters, radishes, onions, tomatoes, and so on and so on and so on, right? So there is some sense in which there's already some and of course in East Africa, countries like Kenya, Ethiopia, Tanzania have entered into things like flowers for a long time, have been, major exporters of horticulture, green beans, and so on and so on. So does Egypt, for that matter, right? So a lot of these countries have started diversifying. But the key thing here, in terms of product diversification, is branding, right? You need to develop a brand. It's how to develop branding products, either from origin or through, corporations and so on and so on. So that has not yet taken a deep root in the region, but it has to. And one way to actually do that, so one of the interesting things about, and this is the second point I want to make, it's one of the interesting things about why continental free trade is important is because actually in continental free trade, they trade more in manufactured goods than they do in raw materials that they do with the rest of the world, right? So extractives, right? So our own research, which is not yet, it's still in development, but what we show is that trade integration by actually reducing transport costs on the roads, on the ports, that increases exports by almost 12% and increases GDP by almost 2% in the region, right? So a lot of that is going to come from a lot of that's going to come from a lot more traded goods, which then create bigger firms that can obviously have an advantage in developing a brand in themselves, right? So I think that's one of the things that is important. And then the other thing that we're promoting is basically integrated digital markets, sub-regional digital markets. So we are investing a lot in that, and hopefully that digitalization of firms in Africa has huge potential for actually increasing jobs and also growth. Because right now, even though 83% or so of African countries have access, or at least are covered by G3 or G4, fourth generation kind of internet access, only 22% of them actually use it for productive use. So if you can increase that productive use of digital technologies in a big way, especially by firms, you could also potentially increase a lot more trade and regional integration. So there's so many other things you could possibly do, but let me stop here.
Thank you. Maybe that's an excellent response. Maybe I can just link that response to what Phyllis was saying, is that basically Phyllis suggested that African women were affected more by the shocks that we've seen as a result of the Russia-Ukraine war, so the depreciation, the food price inflation, and so on. In your response to the shocks, Andrew, you mentioned that it's important to diversify, and that some is happening, but you're working to support integration efforts. if women are hit harder, is there maybe some proactive measures that you are considering to support women to take advantage of integration in Africa?
Yeah, no, exactly. So two things that the World Bank has been doing actually to support integration of women. One is, first of all, if you look at border trading, a lot of that is typically done by women. So if you look at this, there's a big border trade going on between Eastern DRC and say Rwanda, for example, right? And there's always a lot of harassment and a lot of obstacles that are put in place against women in these trades. And so what the World Bank has been doing is to have actually some project which allows for, first of all, making sure that the women report, and first of all, support them in their enterprises, but make sure that they report this kind of harassment, and then it is recorded immediately, and there's some response immediately. And that helps enormously so that they can, so that's one. The second is actually target specifically women-owned enterprises in these SME programs, right? So the World Bank has a whole bunch of small and medium enterprises programs which focus specifically at women's enterprises. And not only to develop those and to make them grow and be profitable, but in some ways, if there is trade integration, broadly speaking, what you would have is an ecosystem of farms. An ecosystem of farms where there are large farms, and then there are a whole lot of other farms that actually supply these larger farms. And these suppliers may be small, but a lot of them will be women-owned enterprises. And so integration actually creates a really vibrant and virtuous ecosystem in general that will be beneficial for women's enterprises. Let me stop here.
Thank you. I'll come back to Phyllis after I've heard from Diana and Ibrahim on the question about diversification. Okay.
Thank you. Just to add on what has been said, one of the other things we are looking at diversification is about the sources of supply, so that we don't just depend on importing food throughout. We can do this through domestic production, of course. So sometimes we have some import sources, we're just depending, on importing from one specific country. We can also diversify the sources. One of the things we can also try to diversify, because in our study we have seen that there's a lot of impact when it comes to consumption, is to ensure that we also do some food policies whereby we ensure that also the people diversify their food consumption rather than only relying on few staple food, so they can also increase consumption of alternative foods, which they have from both imported and domestic sources. And the other diversification here we are looking at is for the energy sources. Countries should look at what they have comparative advantage on. As like, for example, the African continent, it's seen that it accounts for more than 40% of global reserves of copper, manganese, and platinum. Hence, here we are saying the government should explore various investment opportunities. This way, they'll be diversifying their, energy sources instead of just, depending on electricity. They can also go to renewable energy sources. We are endowed with wind, we are endowed with sun, all these things, solar, so that we can be able to tap into this. And at the end of the day, you find that when we have these global shocks, at least we have already cushioned ourselves and it can reduce the risk at the end of the day. So those are the kind of diversification we are looking at, apart from leveraging on the intra-African, continental trade area thing.
Absolutely, that's a key point, is that when we think about diversification, we often jump to conclusion that it's about exports, but it's good to remind us that it's about both imports and exports, and making sure that you can rely on the wide range of importing sources is really important, both for, in this case, food and energy. And that also comes clearly out of your simulations, that the structure of the economies, the extent to which they depend on certain commodities and on commodities from particular locations, is really the determining factor in terms of exposure to the shock. Diversification, how can we achieve that?
Well, okay, actually, let me follow up on Andrew's point about the role of women in smallholders agriculture that could act as intermediaries to larger farms and so on. A different project funded by IDRC, and a lot of credit goes to IDRC on this, on energy transition that we did. We found some very interesting discovery for the cases of Lebanon and Sudan, that actually these two countries, they used to have a parallel market in foreign exchange and heavy subsidies of non-renewable energy products. What happened is that when reform happens, there was an explosion of demand for solar panels by small entrepreneurs in SMEs in agriculture and other services and so on. So this is, I think it's a very important issue, that actually, energy subsidy can be quite detrimental or an obstacle, major obstacle to the development of smallholder agriculture deploying, the renewable energy. In terms of this is one aspect there. In terms of diversification, another paper also, or another research actually, IDRC research that we did at the, at the ERF, we had a major paper, in fact, a report on Sudan, which, by the way, I sent it to Professor Njuguna, who then became the Minister of Finance, because I thought it could be, useful to other countries like Kenya. Given the importance of agriculture in Sudan and the very weak infrastructure and productivity in Sudan, we identified, the problems with agriculture and came up with a strategy. One of the elements of this strategy is guided by the principle of how to make agriculture look like industry. And this is a very important question because, agriculture and tradable services are very important for job creation and for, filling in some gaps that will be experienced as a result of automation and AI application and what have you in manufacturing. And so we came up with this idea, we identified 14 cities that has a diverse set of natural resource base in agriculture, from horticulture to animal production to grain and so on. And then the idea was that in order to develop agriculture and make it, linked strongly with agribusiness, agri-industrialization, is to build development corridor, or to at least facilitate development, the creation of development corridors around productive cities, and provide considerable authority and space for local governments. Decentralized developmental federalism, that is what we called in the case of Sudan. So I think this would be an idea for promoting economic diversification.
Very good. Professor Ndungu is here around, so we shall definitely give your report or highlight that. But also, I think it's really interesting that what you're saying is about, these are targeted responses, right? Or targeted ways to think about agriculture. You want to develop corridors amongst productive cities, and that is basically, that needs proactive action. It's not just
it's also a form of industrial policy, And actually, by the way, Professor Njuguna came back to me and he said that he was going to look into this paper very carefully. So hopefully it might help also.
Very good. Excellent. Before I bring in Victor, who's just come online, maybe Phyllis, I don't know whether you wanted to respond or had any complimentary comments around the policy responses to increase resilience, which Andrew highlighted around trade issues, and particularly how can policy responses to increase resilience maybe around the trade area in particular take into account the position of women.
The combination of financing SMEs and scaling financing for women-led SMEs in combination with boosting and supporting trade, I think is particularly important also from a economic agglomeration perspective. So just fostering, as Andrew said, an ecosystem of companies that support each other. And in that context, I think what's equally important is the fostering of inward investment that promotes the employment of women, the investment in women from a human capital development perspective as well, in the multi-sectoral, sort of in the agriculture sector and the export-related sectors as well. So my thought was around that agglomeration effect to promote resilience through ecosystems.
Okay, thank you. And it's also bringing together different elements of the ecosystem, which is really important. So some of the things that you've mentioned, Ibrahim and Diana, will also be sort of finalizing quite soon in the coming few minutes. Is sort of also there's also important research agendas going forward, and one area that you mentioned was the distribution of consequences, and I know you're going to do much bit more on that, and maybe you want to say something on that. The other angle, and that you already highlighted also about the way monetary and fiscal authorities could work together to respond to crises, and that we may not know enough yet about the sort of the monetary channels or the financial channels of different shocks. So we often look into the real sector linkages, the direct trade linkages. We also look at commodity prices and how commodity prices then affect different countries. And we have got a good handle on that thanks to the ERC and ERF research for a range of countries. But there's also the other channels which are perhaps more difficult to examine, which are about global monetary tightening, interest rates, monetary channels. And here I want to bring in perhaps Victor Morinda, professor at SOAS, who has started some work around the way to which, the extent to which central banks can help build resilience to crisis. So maybe you want to say a couple of comments on that particular topic, and then we after that we'll maybe one or two comments coming in from the audience, and then I'll turn to Diana and Ibrahim, and then we finalize. Thank you. Over to you, Victor.
Thank you, Doug, and greetings to members in this conversation. And apologies, I'm coming in late because of another parallel function. I think these are critically important issues. The fact that these shocks, and we need to bear in mind that these shocks, the waves of shocks, go back about 25 years running in row. I don't know whether it's possible to share a screen here, right? If I could share.
Not sure.
Yeah. So this is what I'm sharing about, what African economies have been going through. For these, this is taken from one of my recent papers, where I'm looking at the shocks, including the recent shocks, but actually going back to the last 25 years on African economies trying to ride through these waves. And the fact that these shocks have all been external, have hit African economies when they are least expected, and that if actually one looks at the nature of these shocks, what they have in common is the fact of the coexistence of a market failure as well as regulatory failure. And that if you track in any one of those shocks across time, and then see the response by each central bank in particular, by how each central bank and monetary authorities have reacted within the African continent. I think the monetary authorities and central banks have done a good job. They have reacted. Of course, they are not homogeneous of degree one. So there have been big differences in terms of the central banks and monetary authorities responding to shocks using the instruments available. And as we come closer to COVID-19 and recent shocks, some of the tools being employed were the macroprudential regulatory shocks. In that paper, I identify 17 instruments of those regulatory shocks. This is a joint paper with Ease of Somalia, Lavar, and Botiano at the Central Bank of Canada. And we identify those 16 instruments. What is so interesting, what I will share with you in this, is that maybe the pinpoint targeting of the combination of the instruments of these 17 instruments, depending on the nature of the shocks, is really what matters. So the idea would not be just blanket use of those macroprudential tools, but actually being able to combine any of those 17 tools and raise a shock, because the shocks may be mainly targeting maybe foreign exchange, depleting foreign exchange reserves, and then the reaction may be impacting on inflation. The recent shocks have, whereby inflation has gone up almost in each and every country, and central banks have reacted by hiking interest rates, a trend that is a global trend, but actually reasonably well. Although again here you see a lot of differences. You also get a fear that the natural resource endowments have not been could not explain why there are different successes of different ways in which central banks are responding to these shocks. But in general, looking at the responses, if I look across more than, say, 50 countries, and you see, you categorize the responses, say, within the last 24 months, you actually will reach a conclusion that there is something about the design, the architecture of the central banks, the way they are designed, that requires a little bit of re-examination. That we need to consider the building blocks of these central banks. And we actually kind of identify 6 elements of the building blocks that we need to look into, and for central banks and other regulatory agencies to consider. That includes, for example, how to integrate productively the rise of Pan-African banks and the role they could play. These indigenous banks from Africa that are dominating the continent now, a recent innovation in the last 20 years, with hubs in Kenya, hubs in South Africa, hubs in Nigeria, and hubs in Morocco. Because it's the resilience of the internal financial markets and financial institutions that matter in the face of these shocks. Now, how can Pan-African banks, being on the rise, how can they play a leading role? That's block number 1. Block number 2 is the building of peer-to-peer trust, and especially the role of the interbank markets, which is sometimes ignored in the building of resilience. The way, if the interbank market is segmented, we experience, and we look at Uganda, Kenya, Malawi, Zambia, If the interbank market is segmented, then resilience becomes a little bit difficult. Okay. And then building block number 3 is again to going back to the big question of central bank independence and the degrees of freedom in all the classification, about 8 classification of central bank independence, and find those central banks are independent, have a little bit more leverage in responding very quickly. And so revisiting that question of central bank independence, especially governance mechanisms and ability of the central bank governor to respond very quickly does matter. Then building block number 4 is of course the redesign of the fintech revolution, and the fact that central banks in Africa now at the mercy of this revolution that is going to central bank digital currencies. I think this is an issue that has to be on the table in terms of the migration of central bank digital currencies, notwithstanding the digital divide across North and South in which fintech comes in. Another building block is building on the climate risk mitigation and the flow of climate finance. And climate finance in either one as a financing channel and second as a mitigation channel. Finally, how the prospects for regional integration for central banks to come together, that in a way, one can look at it in either way. It could be a basis for contagion, but it could be also a basis for potential solutions. How should this work? Because maybe one size will not fit all. We do create a synthetic currency for the East African region and look at how the synthetic currency behaves within the threshold, okay, like the snake and the tunnel, within the threshold to see how it moves vis-a-vis the national currency. So we have a synthetic currency we have created, and we see how it moves against the Kenyan shilling, the Tanzanian shilling, and the Rwandan currency, and how it also behaves when you change the synthetic and include in Burundi and South Sudan. So I'm positive, but final comment, Doug, is that when we say central banks and monetary authorities respond, yes, they have responded, they continue to respond. But we should not forget that, for example, the inflationary pressures have a big component of supply side elements. Okay, so the standard models we have used in the literature, whereby you look at the demand at the supply side, a production function, and the labor market, and you then have inflation or prices determined on the supply side of the model. And given the way supply value chains have been blocked and are not yet actually fully blocked on the African continent, are not actually fully unblocked, globally. Even in London, as you can see on the supply side, you still have some problems. So the problem is not on the monetary authorities; it has to do much more than just demand management.
Yeah. All right. Thanks, Victor. That's fine. A very interesting presentation. So if you just a one-word answer to question, because I think this came up in one of the policy recommendations of the paper by Diana, was basically to say that monetary authorities in Africa could have done more to respond to the inflationary pressures. Do you think they should have done more, or no, they've done enough, or it depends? Just a one-word answer.
That's directed to me? Oh.
Yes.
Okay, thank you. No, I think most of them have done well, to be fair. I think most of them have done well. Most of them have worked within the instruments they possess. And when we see redesign and restructuring or rethinking the functionality of central banking, even actually using even conventional theory on central banking, the redesign becomes imperative. That is to make it much better, much easier for central banks to respond to some of these shocks. But as I say, not one size fits all. There is a high degree of heterogeneity among the the central banks. And actually a quasi experiment would, even if you actually, divide the central banks in a quasi experiment whereby taking, for example, a resource endowed countries and those which are not resource endowed, and then the rate of response, those which responded immediately within the first 6 months, and those that it took 1 year for them to respond, okay? But once again, I think I would say they've done reasonably well. It's only that in most cases, the supply side and special packages for special groups, the gender, small industries, which were wiped out, it was not forthcoming. The demand side cannot do miracles.
All right, thanks, Victor. We need to close now. The meeting is coming to an end. Maybe just 30 seconds from Diana and Ibrahim on what's next. So you've heard this discussion. You've laid out clearly phase 1 research results, and you're engaged in phase 2. What are you taking away? What is the next stage on this? Maybe Diana first.
All right, thank you very much. What we are taking away from this, first, the recommendations should be sort of specific to the countries and to the populations, because each of them are affected differently. So going forward, we are getting to phase 2 of this project, whereby we are looking at evidence-informed and gender responsive. Now we are targeting groups, and also we are getting specific to countries. So basically, we are going to address the current impacts of the war on food security and enhance longer-term resilience, basically to shocks for vulnerable populations in low-income countries. So basically, that's how we are moving forward from where we are, and probably just because we are looking at the macroeconomic part of it, we analyze the effect of the macroeconomic shocks or mitigation policies on socioeconomic indicators at individual and household levels. Yes, probably I would hand it over to my colleague.
I think what's next really would be also to look into the distribution and consequences, which is this paper that is coming out, and explore possibilities for scaling up this particular kind of research by generating the kind of surveys and data that would be needed, and making this data available to, because our 2 institutions are grassroots kind of research institutions, so it's very important to make it available to researchers, universities, and so on, for research, in addition to whatever research that would be commissioned. And I think, as I said, the macro institutional aspects, of how to enhance resilience at the macroeconomic level is very, very important.
Well, thank you. We're looking forward to the next phases. I'd just like to thank now the panelists. So Kathy, unfortunately, already had to leave. Thanks, Andrew, very much for your comments throughout, and your presentation and your work. Victor, also thank you very much for joining us towards the end. I think that's also very interesting and important agenda going forward. So we look forward to working more with ERF and ARC and the IDRC on the next stages. And thank you very much for joining into the online audience. Thank you very much for the people here, and looking forward to seeing you again. Thank you. Bye.
And thank you, Dak. Thank you very much. Thank you for inviting us.
Bye-bye. Thank you.
Okay, bye-bye.